Hi, everybody. This is the investing teacher, high school science teacher, teaching others how to invest. In this update video on the 2% challenge, I'm going to go over the cash secured puts and buy to closes on positions that I did for the week. I'm going to look at some subscriber questions and two possible positions for next week. Let's get right to it. Okay, if you look at the positions that are in red and blue, those are all positions that I made this week. The red positions were actual buy to closes, and the blue positions are currently open. So starting on 111, I waited a few hours after the price of Bitcoin dropped pretty significantly and sold a cash secure put on Riot and Mara. They're both Bitcoin mining companies. I did a weekly expiration here, which is pretty uncommon for me, but I wanted to see how it goes, mostly because stock prices were at 22, strike prices were at 18.19. So the stock would still have to go down almost 20% in a week in order to start losing money. The premiums were really juicy. 99.104% gains is 500%. And the deltas were relatively low because it already went down a bit, and I'm picking 20% less. I literally bought to close it the next day, $25 for the first one, $36 for the others, $74 and $68 in a day. That might be the best returns that I get all year in the end. Total profit was already at $700 in 2 weeks. Um, Three other positions I actually did four positions on 112. Three of them are currently still open. We have Clove, DGLY, which I actually did four positions on, and I'll go over a little more detail on that one, and Dropbox. For Dropbox, I did that as a 2-week expiration. The others were lower in strike price. I did a 1 month, about a month and a week. Premiums were pretty good because I'm getting almost 100% annual gain there, and the deltas again are low. See what happens on those. Dropbox already, by the way, is close to $22 in the first week. I think it was at $22.40 last I checked. So this one might be one that I'm going to have to do a covered call on. And premium still looks pretty good. APHA has to do with marijuana. It made a pretty big jump in stock like immediately after I did it. So I made a $34 premium, and then I bought to close it at 21. I think it was 2 days on that one. Just wanted to clear up some more funds for other positions, but I did make a pretty good return in 2 days, so I went with it. Last position is IDEX. Again, pretty low prices here. I think at $2.50. So I did do four positions on this one. $196 premium. Some of these lower stock prices, if you could get a good bid-ask spread, if you're able to get it on the higher end when you're selling them, you could get really good returns possibly on it. But be very careful because 5-cent difference could be dramatically different. Again, look at all the deltas. They're all 0.3 or less. I don't want to go past 0.4 in any of my trades, okay? Total profit, if all of my ones in blue expire worthless, and I do have one or two more above this, if they all expire worthless, I'm up $1,122 and pretty much the month. And some of these are middle of February, so it's a little bit later, but PLTR might open up in money. These essentially will open up a little more in February and so on. Solar already closed. So there's a good chance that out of the money invested, another 7,000 could open up in February, and then it will be more in the total profit. I don't expect the total profit to be this high every month. I think this is a pretty uncommon month with all the news and high implied volatility. You got to take advantage of that when it comes. So might as well at this point, right? Okay, from the Facebook group and Option Wheel Strategy, and I am a moderator in that group. Highly recommend joining it if you want to see some like-minded individuals that have some even more experience than me in doing these wheel strategies, and there are some beginners as well. Definitely join that group. I'll have the description down below. Here's a few of the questions that they asked. What percent do I look for when I buy to close? So I've been making as part of my main strategy in this is if I could buy to close at 75% of my initial trade, within half the trading period, then I'm going to set that order. And I did that recently with IDEX, I think it was, where I made, say, $100 in premium. I'm going to set a buy to close order at $25. That'd be a 75% gain. And I left it as a good till canceled order, but I'm aware of when that half period is. If I know that we still have the $25 and there's still, only 1 week left, then in that case, I'll probably just hold the position until expiration. But I think 75% in half the trading time. So again, if it's 30-day expiration, if you get 75% in 15 days, that's what I'm personally going through. And that might be a good initial overview of where you might want to look. Next was how I manage buying power. Based on this, I was able to get to the 10,000 that I was trying to invest in the challenge all the day before the end of December. And then you'll notice that my percent invested is almost always within 9,000 or more. When I went to 8250 here, I just immediately made some positions here. So in terms of my buying power, I'm not using margin. This is all in a Roth IRA. I do that for tax reasons, but also I have a lot of my money in the Roth IRA, so I might as well go with it. And how I manage my buying power, I want to leave at least a few $100s available to buy to close positions if needed. But in general, for this strategy, I'm trying my best to make sure that as much funds as possible are actually going into trades. Now, it doesn't necessarily mean that every trade I make will be great. Some of them might be taking a little bit too much risk based on having the exact right strike price, but I'm looking for these smaller positions. Swaggy Stocks, for instance, has a good FD ranker, and you could do it by lower prices. Question, trading the wheel in a down market or in a recent pullback, what would happen? So while I've been doing this strategy, there hasn't been a down market or a recent pullback. Stocks are near all-time highs again. And although some of the Dow Jones, S&P are moving dramatically the last week, some of these positions that I'm opening with the high implied volatility is moving a lot. In a down market, a few things that you want to be aware of are being able to roll down and out. So if you're doing a cash secured put, let's say the stock's at 50, you initially set it at 45 and the stock immediately goes to 45. At that place, you might have to roll down to 40. You might have to go out a few months in order to have a net credit or possibly a small debit, but it might be worth it in the end, especially if it's a dramatic downturn. It's hard to know exactly what to do depending on if you're on the covered call side. So if you already own the stock and you're selling covered calls, the down market will still give you the premiums at least because they'll expire worthless. You could consider going a little higher in the deltas and the covered calls to get a little bit more premium, or you could possibly do lower strike prices than your cost basis, although I don't necessarily recommend that. If the premiums are very juicy, it might be worth doing. So there's a few little subtle strategies you could do with down markets or pullbacks. Next, basics of margin. I'm going to explain more about margin in a future video. So I'm just going to be honest with you guys. I don't know a lot about margin, mostly because I don't use it. I use it in a Roth IRA, and it's all the cash that I have on hand. I do see a lot of people that are interested in using margin and brokerages. So I'm going to do that in a future video. But I personally don't want to use margin. I'm getting very good returns as it is just on the cash that I have. And I don't want to be extremely greedy. Some of the positions I'm making, by the way, seem much more greater than what my goal was. My goal is $200 for the month. I'm already at 1122. So I don't think that I'm taking undue risk with my deltas being relatively low, but the implied volatility is so high, I'm going to take some advantage of that. Some possible option trades that I've been looking at for DGLY might be a good one. They do headsets and digital equipment like video recordings for law enforcement, police. So with the new government with Biden in place, they might be more demand for this. But looking at the stock, it's at 305. If you could sell at 34 days out, a 250, which is an 18% drop, you still make 12% return in 34 days. And your current odds expiring worthless, your delta is 0.26. So even if it did get below 250, there's still a good chance that you could then get your 100 shares, buy covered calls, or sorry, sell covered calls in that case, and then still make a pretty good return. So I personally did DGLY on 112. I did a month and a week out, and the premium was 136 for 4 positions. So only $1,000 in 2.5 times 4. I'm only putting up $1,000 in collateral. If they expire worthless, I'm getting $136 out. 13.6% return in a month and a week is really good. So it is a bit of a riskier play, but something to consider. The volume's very high, open interest is very high. You should get between 30 and 40 relatively easily. Now let's start at the 35 and see if you get it. One that's slightly more conservative out of all things is Macy's. Macy's was thought about going bankrupt possibly in about a year ago, but new stimulus is most likely going to get passed. There's going to be a very good chance that people will go back into retail purchases. Macy's did have a pretty big down day at 6%. That usually means that your cash secured put side usually gets bigger premiums. So typically after a big down day, look for cash secured puts. On a big up day, look for covered calls. Stuck at 1301. If you sell, this is only a week out. If you sell the $12, so it'll still have to go down a whole dollar. Not saying it can't, but it already went down 6%. I think mean reversion might keep it near 13 for only 6 days. You would get 11 cents. 11 cents divided by 12 is a 0.92% return in a week. So one of the last things I wanted to say before I end here is look at different positions that have either high implied volatility or low implied volatility. I did do my previous video in the series about implied volatility. And if you go for high implied volatility, but you could do a much lower strike price for a cash secured put, might as well take advantage of that with these pretty high premiums. As you saw in my previous positions, I'm not doing any at the money. I'm looking pretty much 15 to 20% out of the money and still getting very high returns on these. If you are still very worried about these very high implied volatility, go with ETFs like XLF, XLE. You could get into those for about $3,000. They have low implied volatility, so most likely the share prices won't dramatically go up or down, and you can get some decent returns, 1 to 2% a month that way. All right, so I'm the investing teacher, high school science teacher, teaching others how to invest. Like, subscribe, smash all that good stuff. Definitely helps the channel out. I'm going to be doing a regular series on these videos at least once a week, every Sunday. So tune in and ask, and I'll see you guys next time.